Hi everyone, welcome to our presentation. I'll be now briefly explaining why we decided to choose the net present value. So we personally think that it's a function worth discovering and working with, as it provides the info to know where a business should or should not make an investment.
Now, what's the net present value? Well, it's a difference between the present value of cash inflows and the present value of cash outflows over a period of time. It's used widely across sectors of finance and accounting for determining the value and profitability of anything that involves cash flows, such as a business, an investment security, capital project, etc. Now, a positive NPV implies profitability, meaning that the projected earnings of a project or investment will be more than the anticipated cost. It will be a gain. But if a project gives a negative NPV, this implies a loss. Hence, only projects with a positive NPV should be considered to get money to the company.
So now, the explanation of its use. So the NPV is mostly used to compare your initial investment for a project or an innovation to the present value of the cash flow at a required rate of return. Furthermore, it helps to have an expectation of the money that companies will make out of an investment, and therefore judging whether the investment is worthwhile or not. However, there are some limitations. For example, the risk related to the discount rate. We might use the present discount rate for future returns. However, we don't have the certainty that the discount rate will not change. And also there's a bit of room of error, like for example, when calculating costs.
So companies use it when they're comparing projects at the same time. For example, in the medicinal field, drug developers use it when they want to calculate the future revenues of a drug to determine if it's worth the cost of development. And in the electronics field, companies use it, for example, HP, when considering to whether or not to purchase an equipment to be attached with the main manufacturing machine. So let's take the example of company A. Company A wants to expand its business and is willing to invest €1 million. So for each year, the net inflow we can see in the table of values, €100,000, €250,000, and so on. And to actually calculate it, it's the initial investment over the discount rate plus 1, raised to the power of the number of time periods of future inflow. And the NPV in the end is positive, hence profitable. Therefore, company A would go ahead with the investment.